Right, we've just gone past 9 o'clock, so we better get going because we've got a fun-filled day today. So welcome everybody to BDO's webinar focused on professional services firms. My name is Anna Gerald, for those who don't know me. I'm a tax partner at BDO and I lead our professional services tax team in the UK. So BDO, I'm sure lots of people are familiar with it, but just to be clear, we're a global accounting network and we've got over $10 billion in revenues, and provide a full range of different services, auditing, accounting, all the things you'd expect, as well as tax services in the UK. And across the board in 167 countries with over 90,000 people and counting. So our session today is actually all about people. So focused for professional services, but one of their key assets, people, and all the tax matters that come along with employing those people. Our speakers today are John Weston, Zoe Cuthbert and Chris Henderson, and all come at the angle of people with different areas of expertise. So we'll just take you through it. So first of all, John is an employment tax specialist, experienced in advising clients on both their compliance obligations, making sure that they don't fall foul of things, but also how they can optimize the opportunities for any savings they can take and any efficiencies. Now, John's got the benefit of having worked on the other side of the fence at HMRC in their large business office, as well as large accounting firms. So and then moving on, we've got Zoe, who focuses on expatriate matters. So that's covering both individuals moving to and from the UK, but also regarding anybody else around the world on any global assignments. So in that role, Zoe regularly speaks with a range of offices within the BDO network, any one of the 167 countries that she can be on the phone to, and deals with both the assignee matters and also the employer aspects regarding tax, HR, payroll, social security matters, the full ambit. Then Chris, he advises clients in the design and the implementation of incentive arrangements, whether that just be for cash or share-based incentives. Employee ownership trusts are still very popular, particularly with businesses such as architects. You've got the EMI plans, which are tax effective, and then growth shares, etc., etc. So there's a huge list of different things that people bring in on that front around incentivization of employees. So covering, again, both the UK and in the international aspects, and from the employee and the employer perspective. So on the agenda today, and it's a huge topic, we've tried to pull out specific things that are particularly hot. So as you can see, electric cars with the summit going on in the UK around the ESG agenda, particularly hot topic. The change in the focus regarding the coronavirus job retention scheme. What's been going on with the health and social care levy, if that's passed you by. The labour supply chain due diligence exercise, the things to consider when you're using flexible resources such as third-party labour. The tax implications for remote working, and that's still really hot given the trend for remote working. And then finally, the Vermillion Holdings Limited case and its impact on incentive arrangements. So please do send your questions through and we will deal with those at the end as much as we can. There's a Q&A feature, so just pop those into the box. And then we will also send the recording of the webinar after the session within a few days. But we'll try and cover any Q&A at the end of the session. So please do raise your questions as we go through. And if we don't have time, we can come back to you separately on those. So we'll finish within the hour, so we'll be done by 10. But before all of that, I'll hand over to John.
Thanks very much, Anna. I've got quite a lot of ground to cover, haven't I? So I'll necessarily do that at a fairly high level, but as Anna said, please do come back to me if you've got any queries. To start off with, electric cars, if I could have the first slide, please. Splendid. Well, I'm sure the advent of electric cars hasn't passed anyone by, but it's worth a quick recap in the context of employment benefits in particular, because it's here that we really are seeing them come to the fore. BDO, for instance, are now seeing 70% of new company cars in our own fleet being electric ones. That's quite telling, I think, and being repeated across employers across the patch. So benefits for the employer, what are they? Well, I think there's essentially four. Firstly, when it comes to recruitment and retention, they can be a very powerful tool. For employees, just knowing that the option is there as they contemplate what to do about changing their existing car, I think is a factor in itself. But the attraction, of course, of a new car for a fixed term, fully maintained and insured, etc., means it's always going to be at the top of benefit choices. Anna commented on it before. Environmental credentials, nil CO2 emissions, of course, for electric cars. We're reducing the business carbon footprint. It's going to be particularly useful for those who are having to think about ESG reporting. Costs of electric cars are still up there, but they do benefit from government grants. Low running costs, obviously. Electricity is going to produce lower running costs than petrol or diesel, and just look at the prices recently at the pumps. And a better tax profile generally for electric cars. No road tax, 100% capital allowances, nil Class 1A national insurance, and these arrangements are becoming more and more accessible for small fleets. It used to be just the premise of larger employers with several thousand employees. That's no longer the case. And finally, well, arguably reduced risk compared with, say, an employer being held liable for an accident caused by an employee using their own car, which was, say, poorly maintained or very old or what have you, for business. Benefits for the employee, fairly obvious. The arrangements generally around the provision of electric cars involve obviously a lease provider, and they mirror personal leasing contracts. And I've said before, that will typically include all the insurance, all the maintenance, etc. Very attractive. But without the upfront payment by the employee, or indeed without concerns over personal credit checking, maybe that's an issue for them. Younger drivers in particular also benefit from corporate insurance rates. So if you've got a young guy or girl in the city in their 20s or what have you, who might otherwise find insurance prohibitive, a company car can certainly be worth looking at. The biggest attraction, though, of course, is the fact that electric cars and indeed ultra low emission vehicles benefit from low benefit in kind rates. So for electric vehicles, which is really my focus, we're talking about 1% in the current tax year, rising to 2% all the way up until April 2015. We know that it's going to be no more than 2% for that period. And this compares with 16% only 18 months ago. So quite a substantial change. And of course, the real benefit is that the avoidance rules that otherwise apply to the provision of benefits and prevent you exchanging taxable salary for benefits don't apply with electric cars. So we can actually get into electric cars using salary sacrifice arrangements very, very easily indeed. So overall, the costs of funding a new car compared with doing so from after-tax salary really do make this quite an attractive proposition for employees and employers alike. When it comes to implementation, well, as I've said, typically involves appointment of a third-party leasing company. There's some big names out there who traditionally deal with large fleets. However, others are coming onto the market all of the time, specifically focusing on electric vehicles and smaller fleets, often prepared to offer just single vehicle arrangements. The implementation will, again, as I say, operate via salary sacrifice, and the financial liabilities that arise under what is typically a master lease agreement between the employer and the lease provider are passed on then under this arrangement to the employee. Typically, the employer will also be looking for insurance cover for themselves, of course, to ensure that should an employee leave or go on unpaid leave or what have you, they're not going to be financially exposed, stuck with a car that they don't want. All in all, this usually takes 12 to 16 weeks from the appointment of the lease provider to get things up and running. So not too bad, and actually pretty straightforward in terms of the arrangement as a whole.
Well, John, I have to say it sounds really, really attractive. So is there any catch? Is it really complicated to put in place? Is there, is there anything else that people need to be aware about?
No, I think it is. It is pretty straightforward. There's always some I's to be dotted and T's to be crossed down, and that's right. As I said, it's a lot easier perhaps than it used to be, because lease providers are certainly very familiar with it. The larger ones, particularly so. But those small ones that I mentioned, those who can provide services to employees with smaller fleets are also increasingly au fait with it. What we typically see is a little bit of hand-holding on our part, just to make sure that the documentation is right. You need to make sure that it's tax compliant. So we will typically work with those lease providers to make sure that the salary sacrifice agreement works, perhaps get it approved with HMRC, review the associated leasing documentation, maybe work with the employer on modelling the savings, because obviously they want to know what all of this means for them and employees. But really, we can bring it to fruition quite easily.
Right, thank you.
So next slide, please. Well, I suppose with electric cars, I was talking about something positive. With CJRS as well, it has been positive, certainly as a support to business. But we're going to see a change of focus now. There has been, excuse me, significant HMRC resource tied up in handling CJRS claims, which of course ended on the 30th of September. And they had a lot of staff seconded from different areas of HMRC. No doubt they issued a big sigh of relief last week when the deadline for submitting September claims was reached. But now HMRC, of course, have got to return their focus to more traditional interests, those of ensuring compliance and indeed protecting revenue, with presumably more resource now being available to bolster the efforts of what they've already got, what they've already announced as their taxpayer protection force, set up specifically, in fact, to pursue fraudulent and erroneous claims in this area, and indeed with other claims which are COVID related. HMRC have been using data analytics quite widely to help them in this regard, identifying the potential for excessive claims, and indeed tens of thousands of nudge letters, as they call them, have been issued to employers, sort of saying, we think there's potentially a problem here. Do you want to have a look and tell us, what you think? Not all of those have really proceeded to formal inquiries, but we are now expecting HMRC to be in a position to push ahead with these. And certainly there's no shortage of incentive on the part of HMRC. It's estimated that between 3.5 billion and 7 billion of furlough was incorrectly claimed. In part, I'm sure, due to the inherent complexity of the rules. There were numerous changes in them over the lifetime of the scheme, and employers have often been making their claims in very pressurized circumstances and without the time to study the minutiae of all the rules. So whilst a substantial proportion of employers in professional services may well have repaid their CJRS claims, I understand that, we are saying to those that haven't, and there will be no doubt quite a few of those as well, that a risk remains, and they should really be taking the opportunity to review those claims that they've made and ensure their accuracy. Something that actually, in any event, you may not appreciate this, corporation and self-assessment tax returns will actually require you to do. The financial and time costs of not doing this through being subject to an HMRC inquiry are substantial, with the potential for significant penalties included in any formal settlement if it was to get to that stage with HMRC. That's a fairly unattractive alternative.
Yeah, and your point that you made around the tap effectively have been turned off historically on inquiries just because everybody's been focused on this particular scheme. And we for sure have seen that across the board, not just employment tax matters, but and we definitely expect a real shift change in getting back to sort of catching up on the work that hasn't been done, but also just because there's been so many changes and how many opportunities there are for HMRC to pick up on errors and deliberate cases as well. But do you have any specific recommendations about what people should do about this now?
I think it's act sooner rather than later, to be quite honest with you, Anna. It remains that if you notify an error to HMRC within 90 days of receiving an overpayment, then you're going to remove the risk in terms of penalties or what have you, and HMRC chasing after. But even if you're not in a position to do that, and most people probably are, you know, these claims are going back, aren't they? What, 18 months or so? It still remains the case that the sooner you look at things, the better. If you make a disclosure to HMRC, you present it in the way that is favourable, you know, obviously within the rules, but you have the opportunity to put the position to HMRC yourself rather than them to form their own perceptions. So in doing so, you give yourself an opportunity there, but at the same time you are still mitigating penalties, and the potential to mitigate penalties down to zero through making a voluntary disclosure is still there, compared to perhaps 15 or 30% if HMRC are going to be the ones that instigate that procedure. Review the calculations carefully. Bear in mind, as I say, that you may have to put entries on your tax return in that respect, and if you put those entries on the return inaccurately, you may be complicating the problem, adding to the problem by filing an incorrect return. So it really is worthwhile, as I say, having a look as soon as you can, making sure that the claims have been made on the proper basis. And then if you need to go to HMRC, doing that before they come and knock on your door.
Got it.
Okay, let's go to the next slide, I think, on health and social care levy. I wanted to spend a few minutes on the introduction of this levy, just because of the potential impact it's going to have, obviously, on employment costs for many businesses. And there isn't that much time to plan for it. What have we got now? About 6 months before it comes in April 22. So what is heading rapidly in our direction, as I'm sure you're already familiar, is the introduction of an additional 1.25% charge on earned income, as I say, with effect from 6th of April 2022, a charge that will indeed be levied on employers, employees, and indeed the self-employed alike. So initially through a temporary increase in NIC rates, so that means not just class 1 and class 4, but also class 1A if you've got benefits in kinds, and indeed class 1B if you've got national insurance attached to pay-as-you-earn settlement agreements. The levy is then going to be separated out, and if you like, it's going to stand on its own 2 feet, so to speak, with effect from April 2023. So what this means is that for employers and employees who are really my focus today, the NIC and levy combined for 22-23 is going to rise to 15.05% and 13.25% respectively. So just over 15% for employers, 13.25% for employees, who also, if they're above the upper threshold, are going to have to pay 3.25% on that higher level of earnings as well. So whilst there may be a few practicalities still to be addressed, as you might imagine, the basis of the charge is, I think, pretty straightforward. It will be administered and collected by HMRC in the same way as NIC. As I say, it's just going to be added on top of NIC for 22-23. So it's going to be via the payroll, via P11Ds or PSAs for the employed people. It's going to apply to the same earnings as NIC, so it's going to be subject to the same thresholds, primary and secondary thresholds, etc. Existing NIC releases are going to apply. So, for example, if you've got employees under 21, you've got apprentices under 25, if you're a Freeport, which I know most of you guys out there aren't, but if you're employing veterans, if you're looking to claim employment allowance, all of those are going to be available to offset. The only significant difference is that from April 2023, it will also apply to those employees who are above state pension age, so they're going to be paying the 1.25% as well. So considerations. The principal issue is, of course, budgetary, and factoring in these additional costs into your workforce costings. That could also include the impact on international secondments. Maybe you've got people going to be coming in who are suddenly going to be paying UK NIC. Could also impact large termination payments. Remember, those over £30,000 are now going to be subject to national insurance as well. So you might be wanting to think about those kind of things as well. And also whether or not there's anything that can be done to mitigate this charge. I have to say that the options are probably fairly limited, but salary sacrifice certainly does come to mind, obviously in favour of more NIC efficient benefits. I've been talking about electric cars already, but we've got pensions as well. That remains one to look at.
Yeah, and John, this is really putting additional pressure on wage inflation, on top of wage inflation that we're sort of seeing across the board now in lots of professional services firms, and of course other businesses as well. So do you think this might drive a sort of look for different resourcing options for people?
Yeah, it's very topical, isn't it, for employers? This whole area of how should we engage workers, and should they be employees, or do we have any alternatives? National insurance has always been one of those factors impacts that decision making, and it's not made any easier for employers by adding another 1.25% on it. I think there is the possibility that some employers will see the hike as another reason to engage workers on, say, a self-employed basis, not beyond the realms of possibility. However, I think it's fair to say that the reasonableness of doing so has to be considered in the round and on its own merits. There's no way that employers should be switching someone from employee to self-employed as a basis of an NIC or levy saving strategy.
Yeah.
So it have to be properly thought through.
Yeah. Okay.
Okay, I think my final slide today is going to be on labour supply due diligence. I think with employment taxes, there's always a mixture of the positive with the caveats, if you like. Labour supply due diligence really surrounds this need for flexibility on the part of both engagers and workers, and the fact that they often have to introduce arrangements other than the direct engagement, so just saying, and increasingly do so in order to make things work for both parties. As a result of that, there is a whole swathe of tax legislation that accompanies such arrangements. I'm talking about things like IR35, which I'm sure you've heard about, but also things like managed service company rules and agency regulations. All of these go into the pot to allow HMRC to try and maximise tax revenues as best they can. And the difficulty for the end user is the obligations and risks that sometimes these rules can impose on them, including being liable in some circumstances to PAYE and NIC remaining unpaid further down the labour chain, or indeed them becoming exposed to the reputational and financial risks of being unwittingly associated with tax evasion that might have occurred on the part of third parties somewhere way back, as I say, in that labour chain. Government guidance issued in May goes into quite a lot more detail about this. I would encourage you just to check out gov.uk. If you just type in supply chain, you'll find the relevant documentation. Very useful guidance. However, some important considerations would be carrying out appropriate due diligence in relation to the labour supply chain, where workers are engaged by third-party relationships, and that includes various different aspects. But if the supply of labour is uncharacteristically cheap, question why. It is a very competitive market out there, so really there shouldn't be huge margins between one provider and another. Ensure you know the full length of the labour chain, the parties who are in it, and that includes whether or not any of the workers are operating through personal service companies. Sometimes that's not always obvious, particularly if your own engagement is with, say, an agency. They may not have told you whether or not there's a personal service company involved. So it's definitely worth asking. And indeed checking the nature of the contractual relationships that each party has with each other at every stage in the labour chain, and just so you know how it's working. That will also tell you whether or not other parties are complying with the legislation which governs their role. For example, are agencies making the necessary quarterly reports to HMRC? Is PAYE being operated on all remuneration? And if not, why not? Finally, you might want to think about considering varying your contractual terms. I've done this with some clients to include assurances as to other parties complying with the tax rules and your means of being able to verify these. You might also want to look at limiting the length of the supply chain or parties to be included in it. I'm not saying that all offshore agencies are bad, for example, but certainly if you have got offshore agencies in the chain, there is perhaps an increased risk sometimes for the end client to be on the hook if things go wrong. So in some instances, people might sort of say, well, we don't actually want an offshore agency in the chain. So there's things like that to look at.
Okay, right, John, thank you very much for that. I think we should move on to the expat side of matters, because there's an explosion in sort of issues on that side as well. But thank you very much, John. Sorry, over to you.
Hi, thank you. Thank you, Anna. So we're going to look today at the changing face of global mobility and much more on the working remotely. Many companies have employees working remotely overseas at the moment, either through choice or due to COVID-19 border restrictions. Companies are taking different approaches. Some have asked employers to return to the UK as soon as possible, while others are allowing employees to remain overseas for wellbeing purposes. A company's culture and regulatory environment will impact their appetite for risk and whether they're willing to allow international remote working or not. Companies are aware of risks, tax risks that arise from employees working overseas, but not always aware of the immigration and duty of care responsibilities that come alongside. We have a lot of companies where they did a big exercise to make sure that individuals were working in the right countries and came back if they'd gone overseas and got stuck. But I don't know about you guys, but we're still finding individuals over in different countries that it shouldn't be, thinking that they've taken themselves over there. A lot of employees in their heads think, well, I'm not avoiding tax, I'm paying tax. I'm paying tax through the UK, I'm not avoiding it. It's not what my aim is. I want to pay my tax. But it's about paying the tax in the right countries, and that message is what we've had to get across to a lot of employers, the employees, to make sure they're aware of what's needed from them. We're also finding a lot of the young international employees are demanding more flexibility and different cultural experiences, and then looking for opportunities to work for companies that will allow them to work remotely overseas. So employers are having to look at that and looking at how the best to attract the right talent. So if we can move on to the next slide. On here, we've got a list of the different kinds of workers that we're getting now. We've got the domestic remote worker, people staying at home in their own country, but maybe a different part of that country. Now, in the UK, that doesn't cause an issue other than having to commute to the office when they need to. But in some countries where you've got different states like the US, You can have people moving across country, working in different state, and you've got different tax implications in those different states. So things to be aware of if people, you are allowing people to work from home within the same country. It's not always just an easy fix. Virtual assignments. This happened a lot out of necessity over the last year, where people were meant to go on assignment but couldn't, but actually worked really quite well for some people. So some companies are actually looking at how they can set up virtual assignments and use them more going forward, so that there's not actually any physical relocation, but they're still getting the benefit of working with another team in another country. You've then got the international remote workers, where employees are working remotely for the same firm, the same employer, but from another country. Now, this is what's throwing up most of the questions that we'll talk about. You've still got the business travellers, not so much as in recent times, obviously, but I think this will still pick up for a bit. There is a market now to reduce the travel, but looking at business trips and face-to-face, there's still some need there. So we'll still need to look at keeping an eye on our business traveller and looking at the policy there. And lastly, we've got the commuter assignments, where they're living in one jurisdiction and working in another. We get that a lot in EU countries, and keeping a track of those and where they are and what they're doing is a lot harder when it's so much easier to just go across the border.
Yeah, and Zoe, what are the key things that you're actually seeing? So there's obviously lots of things that could happen, but what's the trend at the moment?
Yeah, I've got a couple of examples for companies we've been talking to. There was a mining company I spoke to, and they've got many different locations where in difficult conditions people are working in mining away from home for long periods of time. They've looked to set up different frameworks. They've got 3 different ones: the remote worker policy, the standard one, working away from home. But they've also put in 2 other policies: informal flex, they've called it, using holiday entitlement, allowing people to go back home, but keeping a track of how many days people are spending, but limiting them to their holiday entitlement, but allowing them in groups, you know, like not just a couple of weeks, using up a group of their holiday. And they've got formal flex, so unpaid leave periods, where they're allowing them to go back in for a certain period of time to see family, so that keeping a track of that, but making it more formal, they can keep more control over that. I've also got some travel companies. There's one in Thailand that are based, a lot of people are based away for a long period of time. And they set up a family reunion program where they allow people to go home for about 7 weeks at a time, so that they can see their family that they haven't been able to see for quite a while.
Yeah, and given lots of professional service firms are global, the sort of things that you've just described there are completely applicable. And it's interesting that different industries are doing different things for these things. So how has it gone down? Is it a good thing? Do you think more people will start introducing these sorts of schemes?
I think I've seen a lot more, and it's where they're looking at, and we'll talk about some other examples later, but it's really been taken up very well. But but there are some downsides here where it's still keeping the control. The travel company themselves thought it was a great idea to allow this 7 weeks, but we're still seeing some overrunning, people staying longer than they should do, or people still going back outside of those 7 weeks. And it's about the number of days people are spending in certain countries to make sure that they don't become taxable or liable to Social Security or another issues. And that's where they need to try and kind of limit them, and people are still going outside of those things. So it's trying to keep ensure that the employees know the implications of those things.
Yeah, and it's outside of people's control, so that's quite difficult. Okay. Yeah.
So if we move on to the next slide, here we've got a few of the other implications. So I'm very much more focused on the income tax. So you've always got the additional tax and Social Security issues that I will tend to be looking at more with employers. Where are they working? Is there a payroll required in the country they've decided to go and live in, and actually carry out their work? What's the Social Security implications for that? And there's a lot of cost there with some of the Social Security. I've had some examples where employees from the UK have moved to France. Now, the Social Security in France can be up to 45% for an employer. That's a lot higher than a UK national insurance employer cost. And so that's taken a big hit for employers if they're deciding to allow employees to work in some of these other European countries where there is higher Social Security. So that does need to be taken into account when looking at policies and what we're allowing employees to do. And the cost of setting up payrolls as well, and then administering them to allow people to work in those countries but sometimes there is that business need and that talent retention is required. So these things need to be done, but it is taking them into account to make sure you are doing the right things in the right countries. So it's just making sure that we are picking that up from an income tax and social security perspective.
Yeah, and then there's sort of the other aspects of tax, which I know is not really the subject today, but you've got corporate tax, you've got VAT, so I mean, it's sort of so connected to other issues. So if there is an issue with an employee, you've got to be thinking about the other side as well.
Yeah, and you've also got the other areas as well that I've put on this slide here that aren't tax at all. Have you got medical insurance, life insurance policies? Does it cover them internationally? The health and safety, still responsible, the duty of care for the individual. What would happen if an individual was injured overseas? Are they insured for that? You've got the technology side. How do you replace equipment if someone's overseas? How do you get those replacements to them and support them from a technology side? The travel costs, who pays for the individual to, if they do need to return to the UK office, who's paying for that? Then you've got the data protection side. What are the data transfer rules in the overseas country? You've got GDPR there to think about. Can they actually work on their laptops in a different country? Is that counted as moving the information? And lastly, communicating the risks to the employees. All the way through this is about making sure employees are aware of the issues, because 9 times out of 10, as I said before, they think, well, I'm doing my job, I'm performing what I need to for the company, I'm not avoiding tax, I am paying my taxes and my social security, and that's not my aim, but it's really getting them to understand the issues that arise for an employer and making sure that is in your company policy. So if we move on to the next slide. So what do I advise companies to start doing? So really what I would advise is companies to, if they're not already, and a lot of companies I know have already done this and have started putting policies in place, and they're going to be ever evolving, I think, over the next couple of years as we get used to the remote working more, work out what works, what doesn't work. So the company needs to consider their priorities. There's the tax risk versus the talent attraction and retention. So, you know, if you need those people and to grow your business, and those people want to work in another country and you've got to attract that talent, it's what you might need to do. But you've also got to weigh that up with the tax risk and the additional costs that are involved, that may be involved in allowing that. Involve all your stakeholders in the business. You need buy-in from the business heads so they assist with the policy implementation. I mean, even as an example, I had my brother call me the other day, who's a partner at a company who wants to do everything he can for his employee. But then I explained to him he needs to speak to his HR, because that's what you have all the time. You have the business leaders wanting to do what they can, but then it's setting a precedent for the rest of the firm, and the HR having control of that, and looking at the policy and what they need to do. So it's getting the stakeholders buy-in and getting their understanding of the whole thing as well. Setting up virtual working groups to determine the policy. Then once you've got that policy in place, implementing a decision tree to determine risk of overseas remote work, to help with those as those requests come in, to make it easy to go through that decision tree to determine whether it's an approval or a rejection for that request. And then implement that policy and making the communication to the employees and the business so that everyone is aware of what needs to be done and why this policy is being put in place.
And Zoe, what would you say were the options that companies have when they're considering what to do about this? Because your point about talent retention is at real odds to this, and the administration costs can really run away with you. So what are you telling people?
I mean, there's many things to consider out there. There might be some reduced costs back home in real estate, maybe, that can offset some of these additional costs. If we don't have as many people in the office, do we need some much more costs from the real estate side of it? Could that offset? Could we look at what we could do from a cost-cutting perspective to offset some of these additional costs that are needed to retain this talent or attract the right talent? Should they be setting up a new entity in some of these locations? There's also other things out there, like people might have heard of employer of record, POEs, companies that will set up for you and employ these individuals on your behalf in some of the locations and manage the payroll for you. There's many pros of this. There's a reduced admin cost and the tasks that they're taking those tasks away from you. And there's also cons there. They don't necessarily mitigate a permanent establishment corporate tax risk. And the employee can't join the company as a whole, from like they can't join the pension scheme, you can't provide benefits, you can't provide share options, for example, if that's the way you remunerate your staff. So there are good sides and bad sides for looking at these employer of record structures. But I would say if you do go for them, please always do check that you know the tax and social security implications yourself as well, to make sure that they are following what needs to be done.
Yeah, and I know your next slide is all about the questions to think about when reviewing your employee population and things. So should we move on to that one?
Yeah, sure. So finally, just as a what you really need to be thinking about is, once you've got that policy in place, how do you go through and agree or disagree to those remote worker requests that are coming through? How do you keep a track of your international remote workers and what they're doing? And we have a tool called Quick Trip, which is was initially designed for business travelers, which is still there to track business travelers the same way it did. We've also adapted it so that it can also assist with remote workers and keeping a track of those, and linking through to your policy. So the same way with business travelers, people wanting pre-approval to these trips, you can do the same thing with pre-approval for remote workers. They request to be working remotely. It will go through a number of decision trees based on what you've decided in your policy, automating a lot of the process for you. The system will look at the tax risks and permanent establishment income, tax, social security, immigration, and it'll flag all of those to help, and posted worker directive, which we haven't gone into, but they're all there when you're making these decisions, and they'll flag those things to allow you to determine what the level of risk is, and based on your appetite for risk and what policy you've set, allow you to go make those decisions. So there's ways of doing that and setting up your policy, then tracking. One thing I haven't gone into detail here a lot is non-resident directors. We've had a lot of people where companies are set up in the UK and they're individuals are company directors on the board. We've now had people move abroad and become non-resident in the UK, but they still have to return for board meetings. Now they think as non-resident, they're not taxable in the UK anymore, but directors can't use treaty exemptions that we have for some employees. Directors are taxable in the UK if they come to the UK and perform duties here, and a payroll will be required. So if they perform duties, if any of your directors are moving overseas, or you have non-resident directors, do make sure that you're keeping a track of where those people are coming to the UK, that you do have a payroll set up for those directors to tax the UK work days there. That's something that comes up a lot with them, a lot of questions from our clients. And then just lastly, we've got the immigration side. I'm not an immigration specialist, but especially post-Brexit, have you done your right to work review? If people are asking to work in Europe and they're not from originally those countries, do they have the work permits required to allow them to work there? So just looking at all the obligations. Tax obviously is the focus from our perspective, but don't forget the other things that go alongside, and just make sure you've got those policies in place and make sure you're communicating it to your employees. So hopefully we've given you some points to consider when looking at policies, and if we can be of any assistance, please do let us know and get in touch. So now I'm going to pass over to Chris, who's going to be talking about a recent case.
Morning, everyone, and thank you, Zoe. I think I have about 10 minutes here to give a very quick summary of the Vermillion case, which was a 2021 case this year, and its impact on share plan incentives and option schemes. I guess taking a step back and setting the scene and asking the question, who is this case of relevance to? I think there are three broad groups. The first is your entrepreneurial business, who will have investors coming in acquiring shares or options in the company, but who subsequently develop a relationship with that company and may be appointed as directors of the business. And subsequent to that, there is a change in that individual's holding of shares or options in the company. The second group, I think, of this case will be of interest to are your deal teams in the private equity industry, who will want to understand when they take over a particular company, the taxation treatment that applies to the exercise of share options and the rollover of shares in particular, to make sure that they can manage any PAYE and NIC risks that arise on that transaction. And this case does have implications for that. And then the third group, I think this is of interest to, are the advisors, particularly the legal advisors, who advise companies on the sale of purchase of businesses, who help on the due diligence process, and also might be responsible for drafting company articles, issuing shares to, or helping companies issue shares to employees. So they'd be like the three broad groups I think this case is of interest to. So before sort of delving into the facts of this case, I just wanted to set out what the main exam question that the court had to consider was, and that is basically as follows. If you have an investor who receives shares or options in a company, but subsequently becomes an employee and that option or share is cancelled and reissued, does that new share or option stand in the shoes of the old share and option, and effectively means it's viewed as being an investment return when that share or option is exercised or sold? Or does the new option stand on its own 2 feet, if you like, and is deemed to be by virtue of that new employment relationship, with the consequence that it's no longer viewed as an investor option and share, and that the gain is subject to an employment tax charge in the hands of the individual selling the share? So turning now to what the facts of this particular case were, we had an investor who came in and helped the business actually raise some finance for it. Instead of taking a fee for those services, he received an option over 2.5% of the shares. Over time, the company got into some dire straits and needed to refinance. And as part of that, a new management team was brought in, and our financier with this 2.5% option was appointed as the CEO. And at the same time as that appointment was granted, had his old option cancelled and a new option granted over a reduced amount of equity. The company, was pleasing to say, was a success, and subsequently that investor employee exercised their option and acquired shares and sought to argue with HMRC that they should be taxed as would be an investor on the gain as a capital gain rather than as an employment tax charge. HMRC disagreed, and both parties couldn't see eye to eye, and this case has then proceeded to go through the courts over a number of years now. Firstly, at the first tier tribunal, where that tribunal found in favour of the taxpayer, i.e. that this was an investor option, or the new option was an investor option and not subject to employment taxes. That was then appealed to the upper tier tribunal, where that tribunal actually sided with HMRC and said actually this was acquired by reason of the employment and therefore should have been subject to employment taxes. And that then was appealed to the Court of Session, which is the case that was heard this year, in which we had the judgment passed down in August. And effectively what the Court of Session decided by a 2-to-1 majority is that that option should be viewed as an investor option, and that therefore that gain shouldn't be subject to employment tax charges. Now, I have to say that the reasons given for that were long and various, and even the two individuals who, or even the two judges who found in favour of the taxpayer got to the same conclusion by different routes. So I'm not going to delve too much into, if you like, the nitty-gritty of the legal argument at a point here. But I do think it's worth us just reflecting and taking a step back to think about what are the implications of this case for people. And I think if we could just quickly trip onto the next slide. So on the face of it, you could argue that as things stand at the moment, this case doesn't have many direct implications for clients. And the reason for that is HMRC is probably likely to appeal it. As I said earlier, this is a 2-to-1 decision. Even the two judges who've sided with the taxpayer had different views on how to get there. So I think there's a high degree of certainty that HMRC will appeal this, and therefore this is not the end game. This is maybe the beginning of the end in terms of getting a conclusion to this case. That said, I actually think there are 2 or 3 principles that we can take away from this case. even as things stand at the moment, and even if the Supreme Court reaches a different decision. And the first of those is, I think care really needs to be taken if an individual comes in with an equity holding or a share option, comes in as an employee, and subsequently there is a change to the nature of that option or share, either as in this case through a cancellation or reissue, or in the case of maybe a shareholding where there might be a cancellation of the share, a buyback and a reissue, which is very common in the entrepreneurial space. The other thing that I think is important is if you look at the dissenting judgment, the judge effectively said that had the option not been cancelled, but the terms of the original option just amended, then this case wouldn't have got to court, i.e. HMRC would not have had an arguable case. And I think that's an important point, particularly for when we're advising clients where you might want to cancel options and reissue, that where you do have a question mark over whether these new options will be employment-related securities, this case may now lead you to, instead of wanting to cancel and reissue, actually just amend the terms of the existing option as a means to reduce the overall risk. So that is where things stand at the moment. As I say, I think it is likely that this case will be appealed to the Supreme Court. So as I said, this is not the end game. And it wouldn't surprise me if in a couple of years, or maybe a bit less, that I'll have a further update for you on this case. So I think, Anna, I'm going to pass back to you just for some concluding comments and some questions and answers.
Yeah, thank you very much, Chris. This is the thing with these court cases, isn't it? It can take a very long time for the actual final position to be settled. But we'll see how things progress. So there have been a couple of questions and a few things that have come up as people have been talking. So just one question, probably for you, Zoe, which is around the number of days that it's sort of almost like a safe harbour. Is there a safe harbour? So what's the maximum number of days a business can allow an employee to remotely work without any tax or social security implications? And I can kind of guess what you're going to say, but
I get this question all the time. Everybody wants an answer to this, to put in their policy to have that set number of days. Now, from a tax perspective, everyone's probably heard of the 183-day rule, where if covered by a double tax treaty, if we have a double tax treaty with that country, if the individual is not working for the benefit of the other company, they're not spending more than 183 days in a 12-month period, and the costs aren't borne by the company in the host location, so they're being paid in the UK, their costs are borne in the UK, nothing's recharged, then you could say that they could spend up to 183 days from a tax perspective. However, that doesn't always mean that that's the end of the answer, because some countries are a lot stricter than others. Some, if you don't file right at the beginning an exemption form, like Canada, are really strict. So you need to have filed something to begin with to get that exemption. Then you don't get it, and you then have the payroll implications. So it's not always just assuming that you can use the 183 day. You've got to check we have a treaty to start with those countries, but then you've also got to check if they've got any stricter rules with regards to registering and making sure that there's no other regulations to file. But there's social security is also the one to be keep an eye on. Yes, we can look at A1 certificates and certificates of coverage to cover people to go, but they do need to be really sent by a company, sent on, on a trip. So we have asked companies to maybe put something in place in writing to say we are asking you to work in that country so we could get an A1 or a certificate of coverage. But A1s as well are now limited to only 2 years. So you've got to look at people's actual circumstances from a long-term perspective. So I've got a few of my clients, we've kind of looked at, say, 30 days being like the safest thing, that countries are unlikely to really go after you, and to look into it's not really worth their while if it's less than 30 to be checking everything up. But I don't want to say a specific date. Every country can be very different.
Yeah, and of course every country needs a lot of money to deal with all of the fallout of what we've been dealing with, so it's very easy to sort of think that it's okay now because that's the common practice right at this moment, but actually within a certain period of time you always start getting inquiries, and dealing with all of that sort of trumps the administration of doing it effectively in the first place. But I think a lot of businesses are suffering from this at the moment, which is just the number of people, even in quite small businesses, that are making choices that are not necessarily agreed with, or that, you know, there wasn't a policy in place. So quite a lot of firefighting, as well as trying to put a policy in place that everybody follows. And so, yeah, a very hot area. And John, one for you around IR35. So we've heard IR35 mentioned for years. It keeps coming up, and every time we do one of these sessions, IR35 gets brought up. So the question is, over the last couple of years, there's not been a lot of evidence that inquiries are being raised around IR35. But are we seeing a shift in that, or, you know, what's the update on the position?
Yeah, I think we are, Anna. I think financial services, oil and gas sectors, we've noticed more inquiries in that area. HMRC have invested so much in IR35 and publicity and what have you that they can't afford not to pursue it. So I am expecting to see a lot more activity over the course of the next 12 or 24 months as they get going with that. I think it will necessarily have to be focused on the makeup of workforce in those different sectors. I think it'll be risk assessed by reference to that. So it'll be interesting to see quite which sector comes next. But certainly there is no doubt that an awareness that on the part of employers is going to be key. It's interesting that one of the first large reports of an employer being caught out was the DWP. I think in the summer, I think they had to pay about 87 million pounds or something to HMRC because they had incorrectly categorised people by reference to CEST, which is a little bit ironic, that being the government's own tool. But I think that in itself does demonstrate that reliance on CEST alone is probably a dangerous sort of strategy, and it's very worthwhile doing that in conjunction with somebody who has specialist knowledge in the area.
Yeah, no, well, I think that's right. And the complexities around people and the flexible, the way that people are sort of driving their own personal position about whether they want to remain as employees or self-employed, and the flexibility is sort of, there's a direction of travel to do with employees and or individuals and the flexibility that they're looking for.
Indeed.
I think we've got time for one more question. So I think, Zoe, I think it's probably the weight of questions around your area as well, which is around if you are considering remote worker options, what should a company do to think through these options? Because we talked about the need for agility and retaining talent, but what's the advice of the company themselves when they're thinking about this?
Muted. It really is about thinking about the cost and the risk that certain companies have very high risk levels, especially financial institutions. You've got the restrictions of allowing people to work overseas and the regulations of what's allowed from a business perspective. But so some companies are more risk averse than others, and it depends on the size of the company as well. But it really is the cost. Like, what is the cost of the company, and checking that that's worth the talent retention. It's your business, and what do you need from your perspective. And we're also looking at the one size does not fit all is what we're finding across the businesses and the different types of companies out there. Especially even within one firm, you've got say you might see it as a tech company, but you've got the manufacturing side where they can't work from home. They need to be in the factories or the warehouses, up to through that same company up to the head office where they are office based and could work from anywhere. And then it's making sure that there's the equality and equity amongst your staff. Some people seeing that they're getting the benefit of some of the employees getting the benefit of working from home or remote working in another location where they can't. So they're looking not just at the remote worker side, but also what can we do to make sure that we're retaining talent where they can't work from home or they can't remote work. What else could we give them to make this company a company people want to work at? One of my clients set up a really nice canteen fully paid for in the factories that they work at and the warehouses. So to make it still giving them something, giving them a benefit that does still make it a nice employer to work for. So it's looking across the board and not just at your remote worker side.
Yeah, very relevant for professional services firms when you're trying to get people trained as well. Anyway, I think we can go on and we can talk about this, you know, for more than just an hour for sure, but I know we need to let people go. So this brings us to the close of the webinar. Thank you all for listening and to our speakers. And we will circulate the slides and the recording of the webinar in due course, as we always do. Anyway, if you've got any feedback on this, please do drop us a note, and we look forward to hosting you the next time. Thank you very much.